Hello everyone, welcome to D-Street School. Today we are going to discuss about the very interesting and basic concepts about how an option trader makes money. Before we jump into the topic, are you the one always lose the money in the market? Or are you the one always thirsty to earn money in the market? If so, this video is especially for you. Today, we are going to discuss about how option trading is differ from normal trading. Before we dig deeper, if you're just new to this channel, I would ask you to watch the entire video so that it will enhance your trading knowledge. If you like this video, go and click the thumbs up button. Please support by subscribing this channel and please do share the video so others will get benefited. I'm Shiva Gurunathan. I'm going to be with you for the next 10 minutes. Let's jump into the session. First, I will give you the overview about the concept that we are going to discuss here. We will start with what is option trading. What are the thought process behind the option trading? We'll go and see that. Once we go and possess the basic knowledge about the option trading, we'll go and find the reason why option traders lose their money in the market. So we'll go and check out the other side of the SWOT, how an option trader consistently making money in the market. Finally, we will go and conclude the video by explaining what is the option Greeks, who is going to be your friend, who's going to be your side, option Greeks or your greed. We'll go and conclude the video in next 10 minutes. Let's start with what is option trading. What is option? Option is a derivative contract which changes its value based on the underlying stock or indexes. Option is also a depreciation asset. It loses its value when it comes to expiry. You can find the option value is very high at the beginning of the contract. The same option value will be very low during the expiry. So after expiry, option has no value for that contract. When we talk about the option, we have to understand main two concepts: who is option buyer and who is option seller, and what is the thought process behind them. Option buyer is pay a very little premium to option seller and buy the rights, which means option buyer have the rights to exercise the contract whenever he wants, but not obligation. If you want to exercise, he can exercise the contract. If you don't want to do that, he doesn't want to do that. Just maximum loss would be the premium which he paid to the option seller. But option sellers always has obligation. Whenever option buyers come and ask to exercise his contract, he has an obligation. I mean, option seller has obligation. So option seller, the maximum profit would be the premium which is received from the option buyer. That's a maximum profit. The maximum loss would be unlimited. You may have a question. So option buyer have an unlimited profit and minimum fixed loss. But option seller on other side has a fixed profit but unlimited loss. Most of the people think option buyers will always makes money because he has an option to earn unlimited profit, right? It's not like that. Usually option writers makes more money than option buyer. But next, before that, we will go and see what are the types of option we have here. Basically, we have two types of option. One is a call option, another one is a put option. Usually when you go and have a call option, your market expectation would be bullish, which means market has to move upside. When you have a put option, your market expectation would be bearish. Like that, so we will go and elaborate in detail. In call option, we have a two leg. One is a long call, another one is a short call. So who's going to be a long call? Buyer. Option buyer is a long call. Option seller is a short call. Now who has an obligation? Option seller is an obligation. I mean option call option, short call option has an obligation. Whenever long call option person exercises right, he has to obligated to that option. So like the same we have another like long put option and short put option. So long put option, the market expectation would be bearish. So short put option, market expectation would be range or bullish. Here, who is going to be option buyer? Long put is the option buyer. Short put is the option seller. So option buyer is a long call and long put. Option seller is a short call and short put. So what is the market view and expectation? Option buyer of a long call always expected market wanted to go high, which means market has to move upward. Only then he makes money. If market is in flat or if market in bearish, he loses his premium, which he paid to option seller. Meantime, if market works favors of market, I mean option buyer, which means whoever takes a long call, option seller, I mean short call, started to panic because his maximum profit is the premium which he received. When the market goes up, he loses his money, which is unlimited loss. The same for long put, market expectation would be the bearish. Whenever the market is bearish, when you initiate a long put, you will make money. So when a market is flat or if it go bull, if go upside, option buyer will loses his money. So short option put expectation would be market wanted to be in flat or bullish. Only then he makes his money. So these are the option types, 4 types: long call, short call, long put, short put. So next we will see why an option trader loses his money in the market. There will be plenty of reason for that. Let me go and explain the very basic information and important thing why option traders always loses their money. First, lack of technical knowledge. Uh, a trader should have a sound technical knowledge about stock market, which means he has to be well thorough in candlestick chart pattern, open interest concepts, other indicator. So he or she able to predict the market, whether market is going to be bullish or bearish or flat market. So he should have a he or she should have a sound knowledge in technical knowledge. People whoever doesn't have a sound knowledge, sound technical knowledge, they will lose their money. And lack of option knowledge. A sound technical knowledge is enough for option trader? No. You should have a knowledge about the option trading. Like I said before, what is the call option, what is the put option, what is the long call and short call, what is the long put and short put. You should know all these things. I gave the very basic information, but a lot of things to learn, like intrinsic value, time value, lot of things comes to option. Lot of things there when we talk about options. So he or she should have a sound knowledge in option trading. So as I said before, apart from those things, a person should have a good knowledge about the option Greeks. So there will be a 4 option Greeks available here, mainly delta, gamma, vega, theta. All these Greeks will give impact in option premium. So each and everyone will play on its own role. So a person should have a sound knowledge about option Greeks. Then a trader should initiate naked position, always loses money. Like as I said before, if you initiate a long call, so your market expectation would be market wanted to go high. Only then you will make money. If market stay flat or it comes down, always you lose money. So it's same applicable to all the types of the option. Whenever you go and initiate a naked position, a option trader will lose their money. So what is the naked position? Simple. If you go and implement any only one leg, for example, if you go and initiate only long call or only long put or only short call or only short put, that's we call it as a naked position. So whenever you take a naked position, there will be a lot of chances to lose the money. How we can overcome this problem? I have an answer for your question. So how an option trader makes money here? Always trade with option strategies, which means don't initiate an option with naked position. like only long call or only short call or only long put or only short put. Always initiate your trade with option strategy. I understood you may have a question here. What is option strategy? Simple. Option strategy is a mixed up of option types. You can go and initiate an option like at a time, like long call and long put. You can go on mix those type and come up with a strategy. We have a lot of strategy here. For your knowledge, I will name out few here: bull call spread, bull put spread, straddle, stangle, covered call, call ratio back spread, bear call ladder, synthetic long. We have a lot of option strategy here. Just I named here few. Then whenever you go and initiate your strategy, please go and know about the market events. So you might have a sound knowledge about technical analysis or option knowledge, all the things, but all the things will be influenced by the market events. An example, you might have RBI might announce its repo ratio or inflation rates. So all this news will be easily influence the market. So there will be a lot of volatile in the market. So before we go on initiate your option strategy, I would recommend you to go and please study the any market events which may occur before the expiry of the contract. So when you follow this basic thing, I'm sure you will make money consistently in the market. So what is option Greeks? Option Greeks is nothing but it describes the various risk factor about the option contract. Like we have different types of option Greeks like a delta, gamma, theta, vega. I will give you the brief introduction here. So we are not going to dig deeper. Just I'm telling you what is delta. Delta is nothing but it simply captures the change in the option premium with respect to changes in the underlying asset. For example, if your Nifty is moving 100 point upward, so what would be the changes in option premium, Nifty option premium? We can go and calculate this by delta. So what is gamma? It captures the changes in the delta with respect to change in underlying. See, delta is capture the changes in the option premium by changes in the underlying asset, but the gamma is it captures the changes in the delta with respect to change in underlying in underlying asset. So theta, since I said the option is a derivative contract, it loses its value as day passes. So you might have a question, how much value it loses every day? So the answer will give you theta. So that theta will give you that answer. So an option premium will loses its money as time passes. Option theta will tell you how much it will lose the money. Finally, Vega is captured the risk of changes in the premium volatility. If increase of volatility by a certain percentage or 3 or 4%, how much is going to increase in option premium or decrease in option premium? So that tells via Vega. This is a very most important concept in the option. So because all these Greeks will influence the option premium. Once you possess this basic knowledge about the options, I'm sure you will make consistently money in the market. So I'm sure it will give you the very basic knowledge about the options, what is the option and why option trader loses money, how option trader consistently making money, and what is Greeks. So I'm sure it will give you the very basic knowledge. If you do have any question, please leave in the comment section. I will revert back to you. As I said before, if you like this topic. If you like my video, go on, click the thumbs up button, and don't forget to subscribe my channel and share this video. We'll go and see on another video. I will come up with other concept. So till then, thank you very much for your time and support. Wish you have a great day.